How do managed futures funds use absolute return strategies? Imagine a fund that aims to make money whether markets go up or down. That's what managed futures funds try to do with absolute return strategies. These funds are managed by specialists called commodity trading advisors. They trade futures contracts across many asset classes like commodities, currencies, stocks, and bonds. The main goal is to produce positive returns no matter what the overall market does. To do this, managed futures funds take both long and short positions. Going long means buying futures contracts expecting prices to rise. Going short means selling futures contracts expecting prices to fall. This flexibility lets them profit from both upward and downward trends in markets. Unlike traditional investments that only buy and hold, these funds can adapt quickly to changing conditions. They also diversify across different asset classes. They might trade energies like oil and natural gas, metals like gold and silver, grains such as wheat and corn, and currencies from around the world. This broad mix helps reduce the chance that a single market movement will hurt the entire fund. It also helps smooth out returns over time. Many managed futures funds use systematic models based on price trends. These models look at historical data to identify when an asset is trending up or down. For example, if a commodities price has been rising steadily, the model might suggest buying futures. If prices are falling, it might recommend selling. Some funds also use other strategies like carry trades, which profit from differences in yields between assets, or macro strategies that look at global economic trends. Derivatives like futures and options are key tools for these funds. They allow the managers to control how much exposure they have to each market and manage risk. Leverage is often used to amplify gains, but it is carefully controlled to avoid large losses. Liquidity is also important, so these funds trade in markets where they can buy and sell quickly without big price swings. Risk management is a big part of their approach. They set limits on how much they can lose on any trade and monitor volatility closely. This helps keep the fund steady even during turbulent times. The goal is to generate alpha, which means returns that are above what you'd expect from just market movements. They look for opportunities in trends, market dislocations, and price behaviors that are less connected to traditional investments. For investors interested in commodities, managed futures funds offer a way to gain exposure to these markets with a chance for positive returns regardless of price directions. They do this by trading futures contracts across many asset classes using systematic strategies that follow trends and spot market inefficiencies. This makes them a useful tool for diversifying a portfolio and improving risk-adjusted returns. In summary, managed futures funds use absolute return strategies by trading a mix of futures contracts with the ability to go long or short. They rely on systematic models like trend following and carry strategies, and they use derivatives and leverage to manage risk and enhance returns. Their focus is on producing positive results no matter how markets move, giving commodity investors a way to diversify and potentially boost their overall investment performance.